for one thing to inform your gut, but know that like, what is the Wayne Gretzky saying? Like you want to skate to where the puck is going, not to where it's been.
How do you think about that today?
That we're going to start using the AI term like this early in the podcast.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Welcome, everybody. Another week, Skippy and Doogles. We here this week have a special guest. Very excited. Aileen Lee. Aileen started Cowboy Ventures, so you may know her from that. Most people probably know the term unicorn. This is one of those terms where it gets made up, I feel like, of where it came from. Either it came from nowhere or it came from, do you know how most quotes are attributed to Warren Buffett, Mark Twain, or Richard Feynman, I feel like? So this could be one of those terms that folks could apply many places, but it was Aileen. Aileen came up with it. So we're going to dive in, ask Aileen questions. But one thing I maybe we'll get to that's usually like not what many folks know you for, but is always diversity in the startup space in tech is critical. I love that you are such an advocate for this. So if we get to that, cool. It's fantastic. But if we don't, anyway, welcome. Appreciate you being here.
Thank you. I hope I get some good stock tips.
If you need them, this is the right place to come.
I know. Clearly.
Although we give research recommendations, people. We don't give stock tips. We give research recommendations. Right. I want to start off here. Both of us are from the best place in the world. I'd love to get a better sense of where you are from, the state that you're from. That's the best place in the world. Where you're from, a little bit about how you grew up, because I think that always makes, for who people are today.
Gosh. Okay. Well, I was born in New York. I was born in Staten Island, New York. I don't know if that's what you're talking about. I grew up in
Jersey.
Which Jersey. I love. I was going to say, I'm actually heading to Jersey soon, which I'm very excited about. I'm going to the shore. And now I live in California, but yes, Jersey was very formative. Jersey energy. I think there's a heart and soul and a directness that you just can't beat and the sense of humor is so. If you follow I think the state of New Jersey on X, the account is hilarious.
I've never done that. I think that's gonna have to be an account.
So funny. Whoever's doing it is a comedic genius.
I was listening to comedian Kevin Smith, who grew up in Jersey as well, talk about the unique spirit that place has. And one of the reasons he hypothesizes is because you're like stuck between New York and Philadelphia, and you kind of have to laugh at yourself, but also, know that you can run with any crowd in the world. It is a fascinating take.
Yeah.
Yeah. It's wonderful. So maybe can we hop into unicorn now?
Sure.
Would you mind giving a definition for what a unicorn is?
Yes.
And then how did you come up with it? So 10 years ago, roughly.
There are different definitions. The definition that I used was basically I had a new investment fund. I had spent 12 years as what we now call a multi-stage fund at Kleiner Perkins, doing Series A, Series B, Series C. And then during that time, Series A was the first round of institutional financing. That's why it's called A, right? It was like the first letter of the alphabet. But then this new stage called seed started, which was pre-A, where people were kind of raising a smaller round to build the product and then raise an A. And so I moved from being like a Series A and beyond investor to being a seed stage investor, where usually the people need the money to build the product. So they don't have a website yet. They may not have any name recognition. They may not have any customers. They're really getting off the ground. And so, but because the tech ecosystem had developed, more individual investors, angels, small funds were setting up shop to basically do seed. And so I moved to seed. I had no investments. I had this new fund called Cowboy Ventures. And I thought, well, before I get too busy and may start making commitments, let me learn about seed. And so I basically just made a list of if I had started 10 years earlier, what are the best companies I could have invested in over the previous 10 years that had raised a seed round, that were based in the US and had basically grown and scaled to be valued either in the public or the private markets at $1 billion or more within 10 years. So we're not talking about like Apple and Cisco, right? Those companies are unicorns, but they were older. So it's really kind of like within a certain time window. Since then, it's definitely taken off much more than I expected. So people don't use the 10-year like 10 years old. They'll do any unicorn, but they don't really count every tech company worth over $1 billion. So I don't think it's really like, it's not really a completely accurate set. And I also look at US based only because we invest primarily in the US. And so I don't, when we do our analysis and learning, because all the markets are so different, we really try and focus our research around US based companies.
Aileen, I've heard you talk about the sourcing component before, and like any good data analyst, I think this makes a ton of sense, right? I'm starting a new fund. I have this focus. I want to figure out what the sweet spot is. I want to go there. What's so interesting about your most recent refresh of the methodology, and we'll talk about some of the numbers and how different thing, and you have to tell us about papercorns and everything else. But it seems like what happened 10 years prior to 2013 in terms of the profile of company that became a unicorn is actually so different than what happened 10 years prior to 2023. Yet you still founded a fund and had great success in that period. So is it fair to say that your idea about sourcing maybe provided a lot of value, but also it's such a moving target? I'm just curious how you think about that.
I think that's such a good observation. Like, it's not, I mean, it's one of the things you want. One of the benefits of having been in this business for over 20 years is you've lived through cycles, you've learned a lot of lessons, right? But you don't want to just rely on the past because, there's like these companies are all outliers kind of by definition. So if you just look for the thing that's worked in the past, you're going to miss all the stuff that happens in the future. So I think you kind of have to use it as like one data source or one thing to inform your gut, but know that, like, what is the Wayne Gretzky saying? Like, you want to skate to where the puck is going, not to where it's been.
How do you think about that today?
We're going to start using the AI term like this early in the podcast.
We can maybe avoid AI entirely, but kind of where's the puck going? Is it only AI? What are people missing?
I think it's very exciting. Thank goodness for AI, because we had such a bull market that, and then we kind of settled into this venture bear market. But you always need kind of like a new reason why, a new why now for there to be a new upgrade cycle, a new innovation cycle. And I do think that AI is the thing that's going to create lots of exciting new companies. And so I'm very grateful for it, because otherwise I think it would be a much sadder story in the private tech company world right now.
So one thing that I find to be interesting and would love to get your thoughts on or reaction to is the difference in the macro environments for this, when this list is published and when the last one was published. And we don't know where this environment will take us. We have the beauty of hindsight for the last one. But if we go back to November 2013, the S&P 500 was up roughly 165% from its 2009 lows. We were 4 years off of the Great Recession. And so now, in hindsight, it was an upswing. Now you progress that. Another decade of bull market. I mean, I'm going to ignore 2020 for a second. We had, but I'll ignore 2020. If you ignore 2020, now the S&P 500 is up 700% from that 2009 bottom. We are 15 years out of the recession. Are we near or at a top? Nobody knows. Is AI going to propel us forward? Nobody knows. But what do you think about the difference in those two macro environments, what that means for unicorns?
That's a really good question, by the way, because I didn't look at, I don't know if like where were multiples back then? I mean, in 2013, SaaS wasn't even really a thing, right? Like now so much in enterprise software and so much in venture is driven off of SaaS multiples and enterprise software multiples. And I mean, in the first set, the vast majority of the companies were consumer. And they had mostly exited, right? Like just it's kind of hard to peel apart. I'm curious what you guys think, right? Because the amount of because I am a venture investor and I think a lot about private markets. I mean, obviously the public markets, they have a huge impact on the private markets, but just the amount of money in the venture capital ecosystem was so much less in 2013 than it is in 2023. And then interest rates. And then when you look at what happened to a bunch of the companies like Snowflake, like Zoom, like Amazon, and like how they grew. And then how that kind of created maybe like a kind of a carrot or a pull for more money to dump into private markets. Like it's kind of hard to separate all of them.
Along the same lines, the macro piece is clearly creates headwinds or tailwinds. And I'm just curious how you think about that in venture, because sometimes every SaaS company, and I'm exaggerating here, but sometimes any SaaS company that can bring in revenue can get a high multiple, can have a chance at moving to unicorn status. And other times there's just too many headwinds in the macro environment for things to really blossom. How much, like, just as you think about your investment portfolio at Cowboy Ventures, how much do you think the macro environment matters, and how it's really a luck skill component question, right?
It does matter a ton, right? Because most companies who start on the venture journey, they're not planning on doing a one and done financing, right? Like most companies, let's say if they start with us at seed, they're planning on raising an A or a B or a C, which means they're going to have to show metrics to be able to raise the next rounds. And what other investors are looking in this kind of supply chain of venture capital, and obviously the supply chain has gotten very long when you look at how long companies stay private now, right? I mean, companies are staying private 12, 15, maybe even more years. We don't know. It's going to keep going because there's been so much private capital, and because the multiples in private multiples are so much richer than public multiples, right? Plus the accountability, the ability to invest in R&D, all the amount of money that you could sell in the secondary markets without having to go public. There's so many things. But to get from seed to A to B, you have to demonstrate, I would say, from 2018 to 2022, the year-over-year growth metric was probably, and your customer retention numbers, for example, whether you were a consumer company or an enterprise company, it was like the primary driver of the ability to raise capital. Now you're looking at gross margins, potential for net margins, potential for EBITDA, LTV to CAC, Rule of 40, like many other things in addition to the growth number. And I think companies at all stages have to be thinking about all those things for them to be able to raise A and B and C and think about where they're heading. And so that the macro environment, sorry, to finish the thought, most venture dollars are going to enterprise software right now, or enterprise oriented companies, right? And so your customer is a business customer. Businesses, because they're suffering from the same, or suffering or experiencing the same change in the macro when it comes to multiples and the change in interest rates, their belts are much tighter. Their budgets are much tighter than they were 5 years ago. They're not like buying everything in sight and being like, give me one of these, because the thing I need is growth. Therefore, I can spend, and interest rates are zero. So I have a really big slush fund to buy a whole bunch of new technology that will help me run faster. Like running faster is no longer the most important thing. And so, and public companies are, their profit margins and their gross margins and their margin improvement quarter over quarter is much more important than it ever was before. So they're just not spending like they were. So it makes it a lot harder for enterprise-oriented companies to drive that growth and those numbers versus 5 years ago.
Mm-hmm.
I just did about 45 seconds of deep research, so I just want to bring to the forefront here. So if I look at, and these won't be directly applicable because we're talking about a mix of private and public, but the PE ratio of the S&P 500. So just to get a sense for the macro of the market, if you go back to November of 2013, we're at roughly 19 was the PE ratio of the S&P 500. Today it's 30. So you can see the difference in multiple expansion there. If I look at SaaS companies and their revenue multiple, that's up about 4x from that point in time. So it's real, at least from my 45 seconds of deep research.
2.5x in 2013, and now it's at a 10x.
It's roughly, I saw an index, so showing like if you peg it back then to where it is now, it's a 4x difference. I don't know what the actual numbers are.
I think my guess is the data set also back in 2013 was way smaller in terms of the number.
Probably. Yes, that's right. Yeah, that's absolutely right. One other thing I want to throw out here, there was a statement that you made in the new post that I felt like it rang true to me. You said coining the term also seems to have affected the market. I go back to, there was this moment where, remember Pando, Sarah Lacey's company, Pando? Yeah. I was at one of her events. She was doing a fireside chat with Stuart Butterfield, and he was talking about Slack, and he mentioned raising around at $1 billion. And the question that she asked was, well, how do you value your company at that much? Because it was kind of new. And he said, well, we have to be worth $1 billion. That was the rationale. And I think that is part of what you're talking about there. $1 billion became this number that had symbolic meaning even more than financial meaning.
There's like some psychological or scientific theory about like when you actually doing the experiment changes the outcome.
Yeah.
Right? Like, yeah, I know. Thank you for noticing that, because it's a really funny thing that it did, like kind of coining it actually, I think it seems like it possibly changed the outcomes. Or I don't know if that's like a sorry or you're welcome.
I guess it depends on whether or not you own options in in some of those companies. Because
I think for a lot of employees, hopefully that's going to be a good thing, and a lot of investors it's going to be a good thing.
I want to continue. My favorite piece of this write up here is where you talk about capital efficiency. And the reason that's my favorite piece, and actually, before I get to the question, I just have a comment. Your logo is maybe the coolest logo on earth. And your background now has the cowboy or cowgirl riding the fish. I've seen the cowboy cowgirl riding a zebra. If you guys sell merch, I am buying out the store. It is amazing. Send me your graphic designer's details. It's so good. So good.
Thank you.
Okay, but on the capital efficiency piece, what Doogles and I deal with all the time is this debate of private market, public markets. What's better? What makes more sense? Liquidity, pricing multiples, all the stuff. There are advantages to having your money tied up, and there are advantages to having your money liquid. When you talk about capital efficiency, you have stats in here like there were 39 unicorns in 2013. Now there's somewhere between probably 350 and 530, depending on how you do the methodology. That sounds like, oh my goodness, this was the perfect time to be in venture. But when you talk about capital efficiency, and I'll let you define that term, but basically meaning how much investment you put in per your return, you say, yeah, you could have just bought like these public companies like Microsoft, Salesforce, Amazon, and actually done better on average. To me, that's so fascinating. And so I'd love for you to break that down.
I mean, that you basically that's true. That's it, right? It's like I'm so long-term bullish on software and the tech industry in general, but you got to really be careful about how much you raise. And this ratio of like what you're saying about capital efficiency, the ratio of how much is your company worth divided by how much you've raised, right? So if you've raised $10 million and you're worth $100 million, you're basically 10x capital efficient. But what happened was, and that's what drove venture returns for years, is that software, because it's historically a very high margin, very high retention business, it was a very profitable business. If you look at the cash flows and the EBITDA of a lot of the biggest software companies, they throw up a lot of cash because you buy the software and you keep paying for it, but they don't actually have to keep investing very much money to keep selling you the product. So it can be a great business. But what happened was, because that delivered such great returns historically, a bunch of people were like, oh, venture's a great category to invest in. Let me send more money into this asset class. And so a lot of money flowed into venture. And those venture funds then had rich coffers and started investing in a lot of companies and throwing a lot more money at companies probably than they needed. But it then, kind of the delta between the valuation and the capital raised got smaller and smaller. And I think that's going to deliver worse returns in the future.
And that's likely why, to tie back to a previous conversation, what succeeds in 2033 might not be enterprise SaaS businesses, correct?
Well, I mean, depending on how important I think agentic technology becomes, there's undercurrents about whether, systems of record and enterprise SaaS is going to be the same in the future in general, because you may not need these big systems of record. But I think if we got to get this capital efficiency thing back into a high returning place. Otherwise, I don't think LPs, like the investors in venture funds, will pull their capital out. Historically, during prior corrections, that hasn't really happened. I just don't think you can get that genie back in the bottle. There's so much money in the world that hasn't had exposure to the asset class, that has wanted to have exposure to venture. But I think it is really we have to be careful that the early stage venture won't deliver the returns that it has historically if we're not smarter about the capital efficiency.
Yeah, the amount of dry powder, at least that I see, that's sitting on the PE side is kind of frightening, given where the rest of the market is. I'm scared of that being delivered. One thing this made me think about is, so this is not caught on like unicorn. However, Skippy coined the term Skippy, which is gonna itself Skippies. So in personal finance, this is what he's talked about. He was saying that, and correct me if anything's wrong here, he's like, we look at the amount of money that somebody might be worth, but we don't look at that as the ratio of what their expenses are. And it's not directly analogous, but it makes me think about the same thing. Because as you were talking about in that last conversation, you can see how many billion-dollar companies have been created, but what you don't look at is how many billions of dollars it took to create the $1 billion of value.
Yeah, right. Yeah,
And yes, and then a lot of people don't know about things like liquidation preference, even going back to whether it is good for the people that have options or not. It depends on what your liquidation preference
that's
is.
right. That's
If you
right.
raised $1 billion and you're worth $1 billion, well, you're actually worth $0
That's
as
right.
far as someone with a 1x liquidation preference is. So it is pretty fascinating there. Should we run
Yeah.
through the key points? Oh, sorry. Go ahead.
Yeah,
Go ahead.
yeah, go for it.
Oh, no, if you had a reaction, go ahead.
Yeah, I mean, well, thank you for reading the piece. I really appreciate that you guys like read past the headlines, because I do love talking about this stuff. I love looking at it. But I mean, if you look at the 2013 capital efficiency, enterprise was so much more capital efficient. Like some companies were like 30, they were worth 30, 40, 50 times how much they had raised, and they delivered incredible returns to the investors, the public market investors, because there was still upside if they went public, and to employees. But and consumer companies were less capital efficient because they spent a lot of money on marketing in a lot of cases. And basically 10 years later, because of all the money and maybe because of the historical returns, basically enterprise software companies were equivalently cash inefficient to consumer companies, which is just, I think, a little messed up. I hope that we can regain the discipline.
Aileen, I know you want to run to the chiropractor, and I have a book recommendation on back pain for you. So let me get that. Can we squeeze in one more question for you?
Yeah.
This question's a little hokey. I'll explain it. This is our typical question we end the show with for all our guests. All right. The question is, what is your dream retirement, and how does that differ from your life today? So really gives you a chance to zoom out, think about all the things you love in life, and see how that compares, what you can change, improve, or maybe you're in the perfect spot right now.
I don't know. Do you have a good answer to this question? I haven't thought about it really.
The thing we both love about the question, I think, and I'm going to speak for Doogles here, is it just forces you to take a moment to think about what you might adjust, and then you can work towards that goal. At least that's what I try and do.
I mean, I hope to be healthy when I retire and to be able to travel. That would be really nice. I hope my family is intact and then I can hang out with my family a bunch. And then I have been working on the side. My side hobby is trying to improve my tennis game, because I learned tennis in the 70s and 80s. And so when I came back to tennis, I don't know, 10 years ago, and I started taking lessons from like a 21-year-old, he started calling me 70s lady, because all my strokes are like from the 70s. Like it's like continental grip, flat, low to high, no spin. And so his whole quest was like trying to teach 70s lady the new tennis. So I'm trying to prepare for being able to play tennis when I'm retired.
And playing tennis for this millennia.
Right. Yeah, exactly. Yeah. I'm kind of feeling like when I'm maybe if I keep working on it when I'm in like the, how there's age brackets, if I, start competing in the 60 and up, I'm going to crush.
There you go.
What I'm hearing is you need a wooden racket. I mean, just fully embrace.
Basically, you looked at me like I had one.
Brilliant piece, like 100% brilliant. It's the type of stuff that we love to debate on the show because it's like thought provoking and there's great data. So thank you so much for coming on.
Oh, thank you for having me. All right. Well, I will hope to see you in person soon. All right. Yeah. Well, if you guys make it out to Palo Alto, let me know.
Will do. Oh, did you get the book recommendation, Kip?
Yeah. What's the book?
Oh, yeah. You've probably heard of it. It's hot in Silicon Valley right now, but Healing Back Pain by Dr. Santo. Okay. It's this really interesting idea. It might be totally crazy, but it's helped me about how a lot of chronic pain is a psychological phenomenon caused a lot by like repressed emotions. And I went 3 years running around to chiropractors and different back surgeons and stuff. And really, this has helped. So crazy out there book, but it might be worth a read.
Check it out. Very interesting. All right. Thank you, guys.
All right. Thank you.
Bye.
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 It was a good conversation.
Yeah. She's so much fun to have on the show.
If we can, it would be great to get her back. We'll see. These folks are busy and whatnot, but thank you, Aileen, for coming on. Let's just say that straight up. Thank you for spending the time with us.
Yeah, exactly. And as a reminder for all the typical fans, hit skippydoogles.com for all things related to the show. We'll post this brilliant piece her and her team put together. That really, Doogles, am I being hyperbolic here? This is like one of the coolest breakdowns of the venture space. And I don't know why it is. I don't know what balance she struck here, but it's just like there's data, but it's also consumable. It's also not something that comes out every quarter. Like it's a 10-year look back. I told you the first time I read this piece, I was like, we have to have her on the show because it's really good. So check it out, skippydoogles.com. listener mail for next show, or if you have additional questions for us or her, we can try and get that answered. skippydoogles@gmail.com. Doogles, am I missing anything?
That sounds about right. Thank you, everybody.
All right. Thanks, guys.